In this video, I will be explaining the basic components of a residual income model and how it is used to value a stock. A residual income model is most appropriate for companies that do not generate positive free cash flow, driven by either negative operating cash flow or volatile CapEx spending. This is seen in companies like financial institutions, or in this example, a utility company. Residual income valuation assumes that the earnings generated by a company should include the true cost of capital, that is, the cost of both debt and equity. The cost of debt is already recognized in interest expense on the income statement, but the cost of equity is not. To account for the cost of equity, we subtract the equity charge from the company's future earnings per share, which is simply the cost of equity times earnings per share. So generally speaking, the residual income approach states that the intrinsic value of a stock is the current book value per share plus the present value of the future additions to book value in excess of the equity charge. In this example, I'm valuing a company called Algonquin Power and Utilities Corporation, whose ticker symbol is AQN. To start, you'll need to forecast out the company's income statement, as I have done here, which requires an analysis of the industry the company operates in, as well as a historical analysis of the company's financial statements to determine a revenue growth rate, expenses as a percentage of revenue, and a dividend payout ratio. Algonquin has had volatile CapEx spending in recent years that has resulted in negative free cash flow to the firm, so we know that a residual income approach is appropriate for the company. To create the valuation model, you need the forecasted earnings per share and dividends per share from your income statement, and the company's current book value per share, which is calculated by dividing shareholders' equity from the balance sheet by the number of shares outstanding from the income statement. The forecasted book values per share are simply EPS minus dividends plus the previous year's book value per share. Residual income is calculated using the formula on the right, which is the EPS minus the previous year's book value per share times the cost of equity, or the equity charge. In the final year's residual income, I've included a terminal value, which is the final year's residual income valued as a perpetuity, assuming that the company will maintain the same residual income in all future years. This is calculated by dividing the last year's residual income by the cost of equity. As we are forecasting into the future, the calculation of the intrinsic value of the stock today uses the present value of the forecasted residual income in each year. The formula for this is simply the residual income for that year divided by 1 plus the cost of equity to the nth power, which n is the number of years into the future for that period. So for 2022, n would be 1, and for 2031, n would be 10. This is represented in the formulas in the present value column. The intrinsic value is then determined by adding the current book value per share and the present values of the forecasted residual income. Based on this model, we see that our intrinsic value is $13.42, which at the time of this valuation was only 4% lower than the market price, which would result in a hold recommendation for AQN. I hope you found this helpful and can now incorporate residual income valuation into your future investment decisions. Thank you for watching.